There is an important difference, and the big difference is the consumers' purchasing power in these countries. So in the US, for example, the average incomes are high, so consumers are willing to pay more for new technologies. In the US, however, business models usually have to be more focused on some sort of a volume model at a lower price point. The big issue with Europe is that it's not a single unified market. It's many fragmented markets. So if you're a startup in France and you're trying to scale to Germany or to Spain, you don't have to navigate just differences in languages. You also have to worry about the differences in tax codes, differences in legal systems, something the European Commission calls the scaling tax. Outside of the structure or the size of the market, it's also something about consumer or entrepreneur preferences as well. So there's a lot been said about differences in risk preferences of entrepreneurs and investors across these different countries. In the US, for example, is famous for having an appetite for risk. So a lot of studies have been done which show that respondents in the US have a much higher failure tolerance than respondents, let's say, in Europe, which the respondents in Europe still attach a lot of stigma to startups failing, for example. Therefore, these US founders sort of have this failure premium that allows them to actually take on riskier projects without worrying too much about how it will look if they fail. So something that's become fairly common, I think, since the late 2010s is these crowdfunding models for firms, which is investors like you and I can directly invest in startups, which is another way of saying that the frictions that match capital to good ideas are sort of being minimized through these models. Another thing that's happening, although on a much smaller scale, is things like initial coin offerings. So firms would issue these digital tokens, and then you and I can buy them, and then we have some ownership of the firm, although there's a lot of regulatory challenges still in that framework. And another thing that I'm very excited about is governments and corporates directly getting in on the action. That it's awesome that governments are pouring in tons of money, sometimes actually joining venture capital funds as LPs and providing a lot of support to these markets and ultimately to these cash-constrained firms. Similarly, some of these big corporates are directly investing in startups, not just providing access to capital, but also providing access to resources, their expertise, their networks, which I think is a great trend going forward. So young firms are what we economists like to call credit constrained, which means it's very difficult for them to get loans from a bank. And one reason for that is because they have very few physical assets, they don't really have a credit history, they don't have a huge revenue stream to borrow against. Which means sometimes ideas that are very good, potentially billion-dollar ideas, never get scaled because they just don't have access to finance, access to capital. And this is where venture capital is very important. So venture capital does this really amazing thing of moving money from people who have it to people who can use it most productively. The idea being that this money is just sitting somewhere and not generating returns for the country, for the economy. It can be channeled to some activities that would actually increase GDP, increase productivity in the country.